There's a website with the CBOE, Chicago Board Options Exchange. The screen that you would look at, and what you do is you enter your symbol in that little yellow box on the upper left corner, and you get, if you look further down the page, you get the implied volatility for calls, for puts, and for the stock as a whole. And you can compare this to the historical volatility, which is what the volatility has been over the last 30 plus days. There's such a thing as a credit spread calculator, and there's lots of these that you can find on the web for free. Most brokers will have them. Here's a picture of a very popular one, and you can either look at a bull put spread or a bear call spread. You enter the premiums, and it will tell you what your profit margin is, your break-even price, and it's worth using one of these things, especially when you're new to the technique, just to give yourself a sense of whether it's likely to be a profitable trade or not. There's a lot of fancy analytic software for options. It's sold on the web, and it's usually pretty expensive. Could be anywhere from $1,000 to $3,000 or $4,000 to get good options analysis packages. Because to really trade options, you need graphs that let you look at the effects of things like time, date, implied volatility, etc. You have to be able to visualize all these things. There is, believe it or not, a free package on the web, Options Oracle, which is actually a quite strong, sophisticated options analysis package. And it is freeware. You can download it for free. Plus, there is a user guide that you have to separately download. That's around 45 pages. If you're going to do this, make sure you get the user guide as well. There's a really cool thing that you can do with credit spreads, and this is what originally got me interested. And in fact, you can apply this to a broad range of other investment situations, including trading stocks as well. The mathematical means exist to actually estimate probable outcomes in advance of the trade. And I don't know anywhere else that you can do this. Most people don't talk about it, but there are actually mathematical techniques. If you look at the implied volatility of the stock and its current price, to tell you how likely it is that it will hit a certain price within a certain period of time, or even touch on that price within a certain period of time. And to do this, you use something called Monte Carlo probability calculation. There's only one that's free that I know of. You enter the current price and the upside downside price. That would be your option prices. The implied volatility, how many trading days there are left until expiration. The current interest rate, and it's a little bit blurry, but if you look down there, you can see that it will calculate probabilities of closing beyond the upside, of ever exceeding the upside, etc. And that will give you a complete description, at least to the extent that you could possibly know in advance. Obviously, these numbers could change every day if something happens with the market. Plus, they're based on an assumption that the data is normally distributed, without a skew. So there are assumptions that go into this. But to the extent possible, you have a reasonable estimate going in of the probability of success. And you should not go into anything with credit spreads without an 80% probability of success.